Power Options tools, Power Options main home screen should now appear there. What you're looking at, is a basic trial view. In the basic trial, those of you that are on the trial, of course, you'll see the 4 steps here, and I encourage you to take advantage of those. Start off with a free quick start guide. You can walk through the various flash tutorials. We have a variety of archived webinars and webinars during the week that you can register for and attend, and of course those of you on a trial or a subscription can register for a free coaching session at any time as well. So you want to make sure you take advantage of those 4 steps as you're getting used to the Power Options tools and just starting your trial. Okay, first question that comes in is related to the Power Options tools, specifically the portfolio. And David asks, is it possible to delete a sale from the Analysis tab under Portfolio? And the answer to your question, David, let me clear this out here and let's show everyone what we're talking about. Let's go to the My Portfolio main view. The portfolio tools, of course, allow us to track and manage our open positions as well as evaluate potential rollout opportunities and adjustments. And in addition to that, view historical transactions. Okay, so we're going to go to the portfolio real quick. This is just the main portfolio where I track and manage the open positions. But one thing we can see here, for example, the original cost basis on Ally Financial when I entered the position about 3 months ago was $19.60. But from adjustments, rolling calls, and actually moving up the put strike price, I have an adjusted cost basis, an effective cost per share there of $21.35. Now, what I'm shown in the portfolio is my open stock position, the March 23 call that I have sold against it, and the June 23 put, which is currently open. But we've rolled from a 21 to a 23 call at one point, and we also rolled from a 20 put up to the 23 strike put at one point as well. So we're not seeing the closed positions. The 2 ways that you can see closed positions, the main portfolio view just shows open positions, but if I go into the transactions field, we can see a running tab by date of the positions I have, and over here we see the realized gain and loss for those particular positions. Now the field that David is talking about is the Analysis tab, the 4th tab up here at the top. So portfolios for open positions. Transactions is showing, you can look at it in different views, but I'm looking at it right now as just the all positions instead of realized or unrealized. But my closed positions and my open positions, which show a not available gain or loss because it hasn't been closed yet, they're all shown on the same screen. Now when I go to Analysis, it's a similar view in the fact that I'm seeing open and closed positions, but it is arranged by underlying stock symbol as opposed to the trade date. So I have positions here, the ones that are highlighted in white or have the white background are those that are closed and have a realized gain or loss for my given stock. Those highlighted in red are the positions that I still have open. So David, to answer your question, let's say that I have, I'm trying to look at something, oh here's a simple one. Let's say that I have this position here where I sold a February 20 call on ALLY on December 6th, and it was a weekly, so it closed on February 3rd here, expired worthless. Okay, this was an example. It wasn't an actual trade, but this was an example we ran. But anyway, here's a call that we sold in December for 60 cents, and it expired in February. But I can't make any adjustments here, David. As you can see, there's no way that I can edit, close, make an adjustment to this edition, this particular closed position as well. I can't make any adjustments here. So let's go back into the transactions field. Okay, and let's find that February 20 call. Might take a little bit of hunting and pecking. But our February 20 call, here we are, that we sold on December 6, 2016, here. Well, let's say that I wanted to edit this position, okay? All right, sorry about that. Delete a sale from the analysis. Okay, so I'm in the transactions field. I'm going to go ahead and click edit. And now from the transactions field, I can choose to delete this record of the option sale. If there is an error, and let's say I actually got 75 cents premium instead of 60, well, I could edit that. But maybe I got 75 cents and I actually had to buy it back for 15 cents, or in this case, $15. And the trade dates remain the same. So from the transactions field, if it's a closed position, David, you can make your edits there. You can delete that sale, or we can make a change. Here I'm just going to make the change where I sold it for 75 and bought it for 15. So let's go ahead and submit that. Now I'm going to go back to our analysis view, David, that you were looking at before on ALLY. You see here, here's my February 20 call, the same realized gain and loss, but now I have it with, I sold it at 75 cents, bought it back for 15 cents, or $15 for one contract. So you can't edit here in the analysis, but you can edit in the transactions view. Okay, and that's now, that being said, here's a position that I just rolled to. I just rolled to the March 23 call. Oh, I did that a couple days ago. I'm sorry, February 17th. I'm sorry. I did it today in this portfolio. This was done a week or two ago. But I rolled out to the March 23 call on ALLY. This is an open position. Sold it for 85 cents. It doesn't expire till March. I haven't bought to close it yet. It's an open position. If I go to edit, I can edit the price, but I can't delete it, and I can't put in a date closed. Why not? Because it's still an open position. So you can only edit realized gain or loss or closed transactions in the transactions menu. If I wanted to make an edit to my March 85 call, I'm sorry, March 23 call that I sold for 85 cents on ALLY, I'll go back to the portfolio view in the open position where it tracks the open positions, and then we'll go to position actions, and then position, then we can go to edit the position, delete the position if it was an erroneous leg. I can put in rolling the leg immediately or do different things of that nature. But anytime you have a position that's open, you edit it in the portfolio. If it hasn't been closed, it hasn't expired, you'll edit it here. All the other edits will be done in the transactions menu. Okay, so you can't do it from that analysis tab under the portfolio, David. You do it from the transactions. All right. Now, when we were looking at the analysis view earlier, I don't know what Scott said. I was in this view. He said, you might explain the transaction loss of 33% because I know you would never have that much of a loss. You might explain the analysis to the transaction. The numbers here, for example, on this position, we're showing a 20% loss. This is on a call leg or a put leg. And it's not based in relation to the stock price. It's based to the single leg. So this 20.6% loss I'm seeing is the fact that I paid $170 for the call. I sold it for $135. So I lost 35 cents on a $170 investment, which is 20.6 of that value. Okay, so that's what it's showing it there. This is a 3.3% gain based on that, and this is a 1.7% loss. So Scott, I'm not sure what you were referring to. Is there a 33% loss here? Yeah, again, anything that's an option, it's reflecting on the line. It's just reflecting the gain or loss on that particular option, not on the position as a whole. It's the individual option leg. That's why it looks like there can be losses greater than 100 because it's basing it off the price of the option. And, if I sold it for one price and had to buy it back higher, that would be a loss on the position, maybe greater than 100%. Let's say I sold a call for 85 cents and bought it back for 350 because the stock gapped up. That would look like a 300, 400% loss. But it's just for the option itself. It's not related to the entire position. I gained more on the stock than I would have on the loss on the call. So let me see here. Go to that. I don't know if you were looking here. Yeah, I do have a 20% loss on UBNT right now. It dropped from 61.75. Well, I got in at 61.75. It went up to 64, and now it's down at 49.28 after the earnings. And I'm okay with that. I haven't made an adjustment yet because I'm looking to see something next week. So yeah, I've lost 12.47 on the stock from my purchase price, or about 20%, but I've gained almost $9 back on the put option. I'm going to look for that as well. Tom asks a question I've seen before, and investors bring it up. I have to go to the custom spread tool to illustrate this. Tom says, can you use a butterfly to hedge a credit spread? Tom, the answer is yes. The other answer is it necessary to do it that way? It's one of the ways you can, but you're potentially turning there's two ways to do it. You could turn your existing credit spread, if you still have maybe 7 to 10 days left on it, into a butterfly, so you could only add 2 legs instead of adding a whole forward-leg position. But I've also seen some investors tout adding a whole new butterfly, adding 4 legs to a 2-leg transactions to repair it. Who wants to mess around with a 6-leg strategy? I don't, personally. I know some investors do, and there's nothing wrong with that. Sam, I don't know, Sam, if you ever, Sam's online with us, of course, I don't know if he ever has a 6-leg position open at one time, but I know he moves in and out quickly from different positions, may have as many as 4 or 5 working legs at a time, or 3 or 4, and that's okay too. And 6 might be okay if it works, but it's a lot to keep track of. I've seen a lot to keep track of for me. But the proof is in the pudding, as they say, Tom. So let's go ahead and take a look here. Give me a thought. That's not a good one. Just let me go back here real quick. I just want to take a look at something. I know things have been moving. AEIS, no, it's not a good one. I'm sorry, that's not really a good one. Maybe eBay is a good one. Okay, I'll use eBay real quick. All right, so let's go back. And eBay, of course, is trading right now at 33.76. And it's been moving around. It had dropped down earlier this week, down about 33.20 or last week or so. So let's take today's date, and let's say I had originally done a bear call spread. I'm going to sell the 33.50 and buy the 34.50. And let's say at the time, I had sold this for, maybe 2 weeks ago, I had sold this for 25 cents, and I bought this one for 10 cents. So a 15-cent net credit on a 1-point spread. It's still going to be a reasonable return, 17%, although the numbers are very small. Okay? But let's take this here. 1-point spread, 33.50 to 34.50. We took in a net credit of 15 cents. So my max risk is 85. If the stock gapped up to 34.50 in this case, we'd have to deliver shares of stock that we don't own, but we have the right to buy them at 34.5. So our broker would buy shares of stock, of course, 34.5. Cover the obligation of the short call to deliver those shares at 33.5. We take $1 loss, we keep the 15 cents. So we're looking 85 to 15 risk-reward ratio, comes out to a 17.6% return. Okay, but now the stock has moved up to 33.76. So we are at expiration, so we would need to manage this. But what do we have here? I have a short call and I have a long call. And as we know, typically a butterfly consists of 2 short calls here at the same strike, an out-of-the-money bought call, and possibly an in-the-money bought call as well. Okay, so I want you to keep that in mind. We're looking for a standard butterfly position. Now, one way to create a butterfly on top of this position, or to turn this position into a butterfly, is just to add the next legs. Okay? And so to add the next leg, what I'm going to do is we have a bear call in place, so I need to add the bull call. Meaning I'm going to sell another 33.5, and I'm going to buy a 32.5. Now this isn't going to look right for a moment, but we're just going to show you the example. So I'm going to sell another one. I could just say sell 2, but we're going to get them at different prices. Okay, so I'm going to put that there, and this price here is going to be at, yeah, it's not too much. It's 26 cents really, because the stock moved up. And we're going to buy that 32.50. Okay, so I was losing, but in this case I'm still losing, aren't I? All right. And so this one doesn't really work, but the reason why it's not working is my own fault. Okay, and the reason why is because I took this position at the same time. So let's change this again. Let's go back completely. And let's say a few days ago, we went out to March 3rd. And at that time, I sold a 33.50 call. We're going to call that 45 cents and did the 34.50 for 15. So it's going to be a 30-cent net credit. Okay, so I'm going to sell this for 45 when the stock was a little bit lower, and we were going to buy this for 15, right? Yeah, it's moved up because the stock has moved up. So let's say this was our bear call spread when the stock was around 33.20, and there's our bear call spread. Tom says, could you have done 2 at the initial CS, call strike? Well, yeah, see, now if I was going to create a butterfly, remember, creating a butterfly is not selling 2 and then, I'm sorry, selling another one and then buying another this one. I have to sell this at the money and buy in the money to create the butterfly. Okay. So at the same time, let's say we did do a butterfly that might have been profitable in the position. Now, hold on one second. Let's take a look here. Let's go back to March 3rd. Now that this, well, let's look at a graph. We're kind of at break even. Okay, we've got a 30-cent net credit. We're right at break even here, just a little bit below, but we want to try to repair it by doing the opposite. I add a bull call debit in, that creates the butterfly. So again, we're going to sell the same strike we had initially, 33.50, which is now at 64 cents. And we are going to go ahead and buy, I'm sorry, that's the, we need to buy there, our deeper in the money 32.50. Just one strike in, 136 to 142 bid-ask spread, so we'll call it 139. Based on the math alone, this would be a reasonable bull call debit. We're essentially going to have a debit of 75 cents for this position between the 64 and the 139 to get $1 back. Our original profit was 30 cents or 42.9%. So now by adding the bull call debit to create the butterfly, we increase our potential return to $55 and we boost the break even up to 34.05. All right, so that profit that we might get from the bull call debit spread is again increasing it. Why don't I typically like this as a repair? Well, the reason why is because now I've given myself 2 ways to lose. Now this is adding 2 legs to create a butterfly, not trading the full butterfly on top of the credit spread. But the reason I don't like this is because I did increase my break even, the upper break even here on this position. But I didn't do anything to cancel the loss if the stock keeps moving against me. You see what I mean? What this repair doesn't do is address the risk that the stock is still going to continue to move against my initial position. Now, if it continues to move, we'll take the full loss on the bear call. We'll have a better probability of making the full gain on the new bull call debit spread we just added to create the butterfly. This is no longer at a credit. We had to do a debit for this transaction. Hey, we paid 45 cents. We did receive a 30-cent net credit up front. We had to pay the debit here of 70, so, or, I'm sorry, yeah, 70 there, 75. So there's our debit of 45 cents. That's okay. As long as the stock ends here, we'll still make the full profit, which is almost double of what we initially expected. You moved your break-evens, your upper and lower break-even, but at the same time, you can still lose to the upside, and you can lose to the downside if the stock retraces now and starts falling back in price. Now, would it fall back below 32.50? Would it have that much of a gain? I don't know. Okay, that's tough to guess at that point. Anything's possible, of course. But this is the way that we investors look at to do that there, okay, is that that's one way to repair it. Now, some investors will try to do a full new butterfly, and what I mean by that, let's see here. What do we know about butterfly? A standard butterfly, of course, you're selling 2 calls typically at the money, or 2 options, could be puts, and you're buying one in the money and one out of the money. It's the most neutral position you can probably do. You don't want the stock to move at all with a butterfly. So our stock's now at 33.76. I've got this 33.50, 34.50 bear call spread. If I added a butterfly now, Tom, what I might do is sell 2 34 calls, and I could use puts too. We're just going to stick with the calls. Try and keep it simple. Sell 2 34 calls by 133 and 135. Okay, so that's by itself as a butterfly. But I'm going to sell 2 of these at the money 34 strike I'm going to buy a 34 and buy a 35. Now we take our bear spread, we add the butterfly. Did it increase the break even a little bit? But this didn't really solve our problem. Adding these 4 legs just means that, hey, we're looking for a little extra peak here. If the stock's around 34, there's a max profit now of 171, which sounds great. But at the same time, we can still lose 229, so you drastically increase your risk by doing this. That's the risk of getting complex, getting too complex with some of these repairs in these positions, okay? And you asked a follow-up question, Tom, there. Let's see here. You said not a call strike, but the initial credit spread, okay? You said, so the initial credit is 2, 4, 6, or 8 even numbers so we can make the conversion easier. I'll talk about that in a moment. Oh, and Sam says, yeah, Sam says he does have a 4-legged spread on. I'm trying to go through the questions here to see what the follow-up is. Is there a better way to improve a credit spread? That's what I was looking at. Okay. All right. So remember what I showed you briefly. Okay. Let me go back to the beginning very quickly. This is one of my favorite repairs if it works, and I think in this situation it will. And I'm going to point you to something else after that, Tom. Let's go back to our March 3rd series. And I'm going to say that we sold that 33.50 for 45 cents. We bought the 34.50, I think I said for 15 cents, okay? So that was our original. We're just going to put back in that original fake bear call spread on eBay. All right, so there's our 30-cent credit and a 42.9% return. Our pivot point is 33.5. I would have rolled, hopefully, before it went in the money, but maybe I missed it, and the stock just gapped up. And remember, this is out to March 3rd, so we're a couple weeks away, 14 days away or so. Now, when I showed the butterfly repair by selling another 33.5 call, which is now in the money, and buying that, we sort of created this kind of risk-reward profile where I could still lose to the downside if the stock reversed, and I could lose to the upside if the stock continued up. I didn't solve the dilemma that my anticipation was the stock was going to be moving down in price. Let's say when the stock was at 33.20 or so is when I would have entered this position, but it's gone the opposite direction. I was wrong on the direction of the stock. So now the question is, did the repair of the converting the credit spread to a butterfly, iron butterfly in this case, well, it's not really an iron butterfly, but yeah, a butterfly position, a call butterfly, excuse me, did that solve the problem if the stock keeps going against me? No. We increased the potential profit, we increased the break even, but we could still suffer a loss to the upside. Well, here's where you have to take a gamble. Okay? You could lose one of two ways. If the stock moved either direction, you could lose in the butterfly repair. But let's say that we've admitted something that we don't like to admit. I was wrong. I was wrong on the direction of the stock. So now what do I want to do? I'm in a bearish position in a bullish stock. How can I convert a bearish strategy to a bullish strategy without closing out the whole bear call spread and opening a bull put spread and evaluating that? Well, something we've done and we like to do occasionally, works best in the situation when you find yourself that the stock has moved above your short call or your short put strike price in a bull put. It's called the pendulum adjustment. Doesn't always work, but what I'm going to look to do is sell to close my 34.5 call, and I'm going to roll it and buy a 32.5 call at a debit. So what I'm going to do is take my bear spread, and with one roll, which might save half a commission or a whole commission, depending on how your broker changes it, I'm going to convert my bear call spread into a bull call debit spread on a stock that's moving up in price and is above my short call strike price. Okay? So very simply, the pendulum adjustment. I would now go in and I would buy back. Now I'm going to sell to close my 34.50 call. I'm not going to touch the 33.50. That's my pivot. I'm going to leave the 33.50 alone. We're going to buy this back for 21 cents. Okay? So I'm going to put in to buy one at 21 cents. Now what's interesting is I'm getting a gain on this, aren't I? I'm adding 6 cents. to my credit here. We paid 15 cents for the 34.50. I'm selling the close it now for 21. Now, I don't want to do that just by itself or leg into it because now I'm left with sort of a strange position here. But let's go ahead now. Oh, I'm sorry. Selling the close. My apologies, folks. We're selling that one. So now I'm sort of in a naked call, which I don't want to be because that has infinite risk. And we've got a 51-cent net credit. Now, let's buy the 32.50 call, which will be expensive because it's in the money. It looks like we said 139. This one's going to be close. But I think it's going to work. Yeah, it's going to work. All right. So with that one move, I rolled my 34.50, that's part of the bear call, down in price. I'm sorry, it should be down here at the 32.50 level, okay? Now, my max profit is only 12 cents. We had a max profit of 30 cents. All right, I gave some of that up by doing this, but where am I? I'm in a position where if the stock continues to move up as it has been, I have a better profit, or I have a better chance of making that profit. I've got a debit now of 88 cents, but a dollar strike difference between my 32.50 and the original 33.50 call that we sold. So if the stock continues to move in the direction, I'm actually in a winning trade. Now, the gamble is what if it reverses and it pulls back? You would have been successful in the bear call to begin with. Well, that's where your own analysis and research comes in. But this is one of the ways one might consider adjusting a credit spread to just swing the long option to create a debit spread that's now in the money and has a better chance of success if the stock goes forward. All right, Tom? And later on, when you have time this weekend, remember, go to powerop.com/webinars.asp. I'll send that to everyone in the chat window there. This is a public page. You do not need to be logged in to view it. And on the webinars page, go to option strategies. And here we have a full presentation on managing your bear call spread, the 7 ways to manage and adjust a bear call spread. And further down the line, a very similar presentation, managing your bull put spreads, the 7 ways to manage a bull put spread. And by 7 ways, I mean the 7 ways we prefer to do it here at PowerOptions that Ernie and I would consider adjusting our positions without getting into that confusion at times of rolling an existing 2-legged spread into a 4-legged spread or adding 4 legs to 6-legged spread and so forth, okay? So that's the trade-off there. But these are the 7 ways, rolling the spread up by itself, just closing the short leg and leaving the long open, moving both legs out, converting the credit spread to a debit spread, or closing out your bear call spread and opening a bull put spread if it seems that the stock's moving against you. But you'll want to check those out. Those are the other ways that I feel are good ways to manage a spread that keeps it simple. As confusing as all of that sounds, you're not getting into these convoluted repairs of adding a ratio call spread or converting it to a butterfly, which still gives you the opportunity to lose potentially in both directions. Okay. Okay, I wanted to read this question all the way through very quickly before I gave a basic thought answer and then showed more. Okay. David M. says, I've traded stocks for years and I feel confident what my position trades need to be in when an earnings report is to be released. Okay. Now, David says he's a novice at radioactive trading. Could you give me some rules or guidelines as to what preferred position my RPM position should be in when an earnings report is soon to be released? What income methods would you use to have your trade in this preferred position? My assumption would be that the rules or guidelines would be different for an income trader versus growth. Is that a correct assumption? Actually, David, it's not, but it depends on the scenario. Okay? Let's talk about a married put position. Oh, sorry, folks. Let me pause the screen here for a second, and I want to just get these numbers here. This is going to look like a terrible position, and I admit that it is, but it's got promise, and I'm going to talk about all the promises. Okay. Here we go. Make sure that the screen comes back up. There we go. This is a radioactive trade. This is a radioactive trading portfolio fusion, radioactivetrading.com. My position on UBNT, Ubiquity Networks, originally opened on January 27th with a cost basis of $61.75. And I'm going to pay attention to the date there of 2/10 in a second. Now, I bought the June 65 put at 7.65. Okay, so that was the original Mary put setup. It carried a risk of 6.3%. By the way, the current stock price you see up here at the top, $49.28. Yes, the stock's down $12, almost 13. Okay. Reason why is because on February 10th, earnings came out for UBNT and the stock collapsed, and it fell down to $8.78 to $55.35 share, down 13.7%. It had gone up to 64 before the earnings. Okay, and that's important because I'm going to talk about that. So on February, we're going to look at some examples of February 9th. Okay, all right. So I'm holding off on UBNT until things calm down, and I decided to wait again, and I'll show you why in a moment. All right, but here's a standard position going into earnings. Let's go back to PowerOptions, and we're going to go to the custom spread, and I'm going to put that together real quick, but I'm also going to go to something else real quick here. Good, okay. Oh, sorry. There we go. Okay, so we're going to put this into our custom spread for UBNT. We had 100 shares at $61.75. We had purchased the June 65 put option for $7.65. Risk of 6.3%. All right, here's our, oh, it's a terrible view. Let me do something real quick here. I'll show you, well, don't really need to see the profit and loss chart yet, but maybe, okay. Now I'm going to change over very quickly. We're going to take a look at the option chain for the stock on February 8th, 2017. Day before the earnings, even 2 days before the earnings, but this is where the stock went up to about 63.66. It was up 95 cents. Now, this is standard expiration only. There are no weeklies on UBNT. Someone would say, oh, well, a good idea is we could have sold the 65 call for about 240. That would cut my risk almost in half. Okay? But the problem with that is, had I sold the February 65 for 240, it's not a problem now, obviously. It's one thing I could have done. Okay? But when the stock was at 64, if it had a 10% or 15% gap up in price, up here at the 65 range, my profit would have done this. Okay? So, where I'm going with this is income method number 1 is not a position I want to be in before expiration. Income method number 5, which also caps the upside, is not something I particularly want to be in before expiration. The best income methods to have looked at that I could have done, maybe regret not doing, is I could have used income method number 3. When the stock was trading at 63.66 on February 9th, okay, let's go back to the chain. I'm going to hold the February, now I'm going to hold the March, and let's go to June. So, on February 8th, this is the historical chain here, I could have sold to close my 65 put somewhere between 80 cents there. It's a bid of 640, ask of 720, so we're going to call it 680. Could have sold to close my 65 put for 680 and bought to open the 65 put for March at 450. That would have been income method number 3. Let's go back. So right before the earnings, let's take out the short call. I'm going to put the put back in. We're going to buy a March 65 put. At that time, remember, So we sell the June that we were holding for a price of $6.80. With the stock up 3 points, we lost about 80 cents on the put option. And that's also because earnings. Now we're going to roll it in time and buy the March 65 for $4.50. Now this would have cut my risk down to 3.1% or only $2.10, roughly in half. Okay, so that's an earnings play. You've probably seen webinars on YouTube where we talk about that in regards to that situation. Okay. Let's see here. I'm seeing some of Sam's information. Okay, so that's something I could have done, but it would have cut the risk in half, but it didn't bulletproof it. So you don't want anything that caps the upside. You do want something that reduces risk, but potentially I'd want to bulletproof it if I use income method number 3. That's shown all over YouTube. There's webinars there about smile before earnings. All right, to tell you the truth, what I should have done, and it's okay that I didn't do it because I've got a repair in mind that's going to help the position, and Fusion subscribers will see that on Monday. I'm sorry, on Tuesday. But what I should have done is use income method number 12. So on around February 7th or February 8th when UBNT was up to 63.66, although it sounds expensive, hindsight's 20/20, and this is maybe why I avoided it. But rather than rolling in the put by selling to close the 65 put and buying to open the near input, which still gave me a risk of 3%, knowing that earnings were coming up and I had a gain on the stock about 3 or 4 points, what I should have done is an income method number 12, where again, as we saw, instead of selling to close my put at 680, the June 65, I would have bought a second one at 680. Now this would have increased my risk on the position, but still would have had a profit to the upside if the stock gapped up 10 or 12%, and I could have adjusted it that way. Would have had a shallow curve here in the middle, but this is still an infinite upside. And right now we'd be looking at a profit of close to about $500, $600 on the position. Yep, $500, $482. So I'd have a gain, $582, an investment of $76.20 on a stock that had fallen 20%. Okay, why didn't I do income method number 12? Well, to be honest, I was more bullish on UBNT. That's why I didn't do anything and waited for it to play out. Okay, it played out wrong. Also, those of you that are following Fusion know that I did income method number 12 on eBay 3 weeks ago, and it did the exact opposite. It went up 10%, and I managed the position now, so I'm still at a profit. I'm at a reasonable profit on eBay, not nearly as high as the profit had I not done income method number 12, because I thought eBay was going to fall with earnings. A lot of the some of the retail stores and things of that nature, eBay's a tech, and it's online, but it's also related to retail, and it's got competition from, Amazon and everything else, Etsy, things that pop up, Pinterest, I don't know if you, some things like that also offer sales. So I thought eBay was actually going to be a negative the way that it looked. I was wrong, but I'm still making a profit on the position. I still have a low risk. This one is at a loss, but it's with the stock down 20%. I'm at a loss of about 6%, 5.8% right now. And come Monday, I'm going to do a combination of some of the things I just showed. There's another way to do income method number 12 that I'm not going to get into. But there's a combination of things I'm going to do. But what I'm waiting for is, you can probably see it here. Right now, the only series available near term from the June series I own are March and February. So I'm going to wait till Tuesday. What happens on Tuesday? I'll have the April expiration, and I will probably have, I doubt it, very slim possibility, but I could have the May expiration as well. But I'm looking at April because I want to have more options. So I could roll the June in and down into March, which doesn't give me enough time to continue to manage, but to April, that might be an interesting move. So that's why I'm waiting for it. That's why I'm not panicked. Also, an interesting question came up, and this was in one of the briefs that I sent out to my Fusion subscribers. In relation to the stock falling, and when I might look to adjust the put, Ash's question, was, on earnings near expiry, put options are very high implied volatility. Maybe a little bit higher, but they're not bad in most cases. He says, I find it best to roll out before earnings with a cheaper long put. Yeah, no, this is just an example of what I would do. What I wanted to illustrate, Ash, here is that the best things to do when you're coming up to earnings, or when earnings are coming up, are use income methods such as number 3 or number 4, which will reduce the original risk you had to the downside, okay, but still leave the upside open. What I don't want to do is something along the lines of 1 or 5, whether your growth or whether your income, which would cap my gain with an earnings coming out, or with income method number 5, we see something like this. Okay, I don't want either of that going into earnings. If I'm right and the stock gaps up, that's when I would want to sell a call and do 1 or 5 or something along those lines. 6 is a possibility because it leaves the upside open, but you got to be careful with the strikes that you select. Okay, and that's the case there. So, but as you bring up the point that you don't want to roll the put because the implied volatility is too high, I can understand that, and the implied volatility in the near term would be higher. But guess what? The rolls that I was doing, other than the ones of rolling closer into March, and I would have done that, could I bulletproof the position regardless of the implied volatility was higher. If I could have bulletproofed UBNT with the gain that it had by rolling it into March, I would have done that so I had no risk to the downside and still unlimited upside. I don't care if the market feels I overpaid for that March put option. If it bulletproofed my position, I'm perfectly fine with that. But on the other side of the table, rolling with number 4 or making the adjustment with 12 that I showed you is that, yeah, these would increase, but if I'm doing anything with selling this put, let's say, and buying a higher strike put for the same series, if one's inflated, they're both inflated. It's a wash. It really is. So doing income method number 4, if I rolled from the June to June because the stock had moved up in price, it doesn't matter to me if they're considered inflated because I'm selling one and I'm buying the other. I'm getting the same benefit. It's a wash. It clears each other out. It cancels each other out, for lack of a better term. But yeah, selling this and buying into March, I am buying into likely a higher implied volatility because March is going to be more affected in the earnings than June. But if it, in my structure, it bulletproofs the position to where I cancel the risk to the downside and still have unlimited upside profit potential, it doesn't bother me if the market thinks I overpaid for that March option because my position's riskless. I'm in a perfect position in that case. I couldn't do it with UBNT, which is why I didn't. It didn't bulletproof it. So yeah, I could have reduced it to a 3% loss. But remember, I was bullish, not bearish. And I was wrong. So I'll take the stock dropping 20% to only have a 6% loss right now with the opportunity to adjust it and repair it to where I might only need the stock to move up to $50 per share, and I could realize potentially around a 1% gain on a stock that I own that's down 20%. Potentially is what I'm going to say. The numbers quite didn't work out the way I wanted to, but I want to wait to see what April series offers for the put premiums and for the call premiums, and we'll see what we can come up with on Tuesday. Okay? All right, so, okay. Oh, and this, I'm sorry, actually, I got your 2 questions. So you did have 2 there. So you said, when do you roll the long put in RadioActive Trade? Do you roll, say, at 30 days to expiry or hold much closer? No. That's all talked about in the blueprint. I never hold the position that close to expiration unless it's already bulletproof. But that's some of the things that are gone through in the exiting the RPM chapter in there as well. Sam wanted to clear up the comment, not clear up the comment I made, but wanted to add his thoughts in there as well. He says he does have 4-leg spreads open at times, and he may add a put or call to those 4-leg spreads to take advantage of movements of earnings. He's talking about Tesla. He had a condor, and then he added sort of calendars too. He's got some spreads that are further out in time, some that are closer in. And he doesn't have any trade on Tesla for the earnings come out on February 22nd as well. Okay. All right. Oh, and Ash says, yeah, normally the longer term put is cheaper due to the implied volatility and you get extra time. Yes and no. The only fair way is to compare it. Let's go back into a search real quick. I'm going to go into the search for Mary Puts here. What month are we in? There's one. Big lots. We've got big lots here. Ash, we could buy the stock at 52.11. I was actually looking at the stock today. I'm holding off on it for a while as a potential radioactive trade. But there's a July 52.5 put, which would put us at a risk of 8.4%. And earnings are coming out on March 3rd, so 14 days away. Okay. Look at the profit and loss chart very quickly. And I just want to see something here. So the March series, the 52.5 put, is priced at 255 to 290, with earnings coming up in 14 days. So let's call that a midpoint of, I don't know, 274 or so. Let's just call it 275. Our July put is 470 to 520. 50 cents there, blah, blah, blah. So 495. Okay, so the July option is $2.25 more, technically, than the March. And it's 6 times the amount of time, roughly, added time there. Let me add this one in. I'm sorry. Let me add the 5250 in for March just to look at something real quick. Okay. The reason why I'm bringing this up is I want to just take a look here at these two options. So it's 14 days. Maybe that's not enough. Maybe it needs to be 10 days closer. But let's go to the option research tool for a March 5250. We know the stock has earnings coming up in 14 days. And what I'm looking at here is that our March has a current implied volatility of 0.433. Looks pretty high for big lots. And our IV over HV ratio is 1.5. Okay, so that tells us that, okay, so the stock volatility on big lots is probably only around 0.22, 0.21, somewhere in that range, okay? So, but the IV over HV, the implied volatility of our option divided by the historical volatility of stock is 1.5. So some investors would say that that means that the option is roughly 50% overvalued compared to its historic volatility. The Black-Scholes 20-day ratio, which is the ratio of the actual trading price of the option divided by its theoretical worth, is at 157. So that's also telling us it's 57% overvalued. And the 50-day Black-Scholes is at 36%. All right, but we've got a 1.5% IV over HV ratio. Now let's take a look at our July, which should not be as affected as much. But it's still overvalued. Okay, so the implied volatility is 0.345. So why am I showing this? I'm showing this to show everyone that Ash is correct. In normal situations, that nearer term option that we're looking at, a 52.5 strike here, the nearer term option is going to have a higher implied volatility and considered to be more overvalued than the farther out. Our farther out option is 20% overvalued based on the implied volatility versus historical. The March is 50% overvalued based on the IV ranges. But, and that would be the same across the board. So, where's the relevance of this? Let's take a different position. I want to see where Big Lots has been. Let's go to big charts. Perfect. 10 days ago. Maybe a little bit more, maybe 12 days ago. I'm going to go back 12 days. I'm going to go back to the option chain, and we're going to take a look at, use the historical chain again. I'm sorry, folks. I want to go back to the historical chain here for a different reason. What I want to see, I'm sorry. There we go. What I want to see here all right, there we go. It's 10 days ago. I just want to look at the put chain. And we're going to keep with July. Let's go back to the 3rd. Let's go back a little further. I might even go back to January, but let me check. There we go. Okay. February 1st, Big Lots 49.55. I'm going to July. And my July 50 put is at 5.15. Okay, so 49.55 and 5.15. Now, we already talked about looking at the IV-HV ratio for that 52.5 put for July is 1.2%. And the 52.5 put for March had an IV-HV ratio of 1.5, so it was 50% overvalued, okay? But what I want to take a look at now is, let's say we did the big lots position, but we did it on February 1st where we got the stock at 49.55, and at that time I bought the July 50 put for 5.15. Now this is going to be a higher risk than I normally take, but I want to just show this as an example here. Okay, so it's an 8.6% risk on this particular married put position. Okay. Oops. Oh, sorry, there we go. Okay. All right. So we've got an 8.6%. Now, we know that the near-term options are inflated. All of that March series has an implied volatility of around 0.43, where the July is only at 0.34. But in this case, if I did sort of a 3 in this situation, now that the stock has moved up, what if I sold my July 50, 375 at the midpoint, okay, and then I bought the March 52.5 for 275. So now I'm getting a credit of $1. I'm selling to close the 50 for 375. Yes, I'm taking a loss on it, but I'm buying the 52.5 for 275. So I'm getting a credit of $1 and increasing my payout by 250. Okay, so it didn't bulletproof it. That's what I was looking for. But I've taken the risk from 8.6% down to 2.2%. And again, we take a look at the research tool for the March option. Over here, we see that our implied volatility again is 0.4332. My IV over HV ratio is 1.5. So yeah, I overpaid for this put. But at the same time, in the structure already done, I don't care if the market thinks I overpaid for this because I reduced my risk going into earnings by 4.6% 10 days before the earnings, 14 days before the earnings. So it is overvalued. The nearer term option will be overvalued as you're coming up to earnings with income method number 3. But if you set up the original structure correctly and the stock has moved up, you could do this scenario and potentially get close to a bulletproof status going into earnings. As I mentioned, there's a couple ones there as well. And it doesn't matter to me if the market thinks it's overvalued because my new outlook going into earnings is now I have a 2.2% risk instead of an 8.6% risk, still have unlimited upside profit potential. That's a good place to be in, regardless if the market thinks I overpaid for this March 52.50 put. Okay. And ask your follow-up question related to the blueprint. You have a blueprint already. How much is it to upgrade? Depending on your edition of the blueprint, many investors can just log on to radioactivetrading.com. It'll recognize you as a blueprint owner. You can just download the PDFs. However, if you have too old of a version, and there's going to be too many updates, I think it's any edition older than 6. So if you have edition 5 or 4, a previous blueprint owner can pick up an updated blueprint for the price of $39, and then of course plus the shipping as well. All right. Okay, so let me take a look here real quick. I just want to look at one more thing. Oh, good. Harvey is here. Okay, so once again here, let me do a quick little shift. And if you have any last-minute questions, go ahead and send them in. We're at 5:30, but I promised Harvey that I'd make mention of this going forward. Harvey called me right before, maybe half an hour, 40 minutes before the webinar started. Harvey wanted to know, would you still use, now that we've covered some of the married puts radioactive trading concepts, he said, would you still use married puts radioactive trading techniques in the current market situation? The market situation being that it's hitting extremely new highs, going above new high levels, so everyone's saying it's bound to fall. So it's bound to fall, right? Well, we don't know. Many of us expected to fall earlier. Many of us expected the retracement to happen sooner. We might not see the retracement for another 2 months. It's hard to tell. The short answer to this question is, would you still use married puts? because we've been going so much so soon, the market has to give back a little bit, so we're expecting retracement. We still do use married puts, and the answer is yes. Number one, well, the short answer is yes. Well, why? Number one, I've already got positions that are protected by a put in a married put transaction that have a low risk. So I'm going to keep trading them as a radioactive trade. Sure, if I expect there's a downturn coming, I might use income method number 12 that we looked at briefly. I might do a different type of adjustment to play the downside as well as the upside. If I think we're in a downturn, I might even do something different in my existing radioactive trades. Now, if I think the stock's moving down in price, would I still look for positions for radioactive trade? Well, yes. You can typically still find bulls in a bear market. It's not the easiest thing to do, but there are always bull stocks in a bear market, and there are always bear stocks in a bull market. So you can kind of find those, and you can search for those, and even if you don't get it right, you thought you found a bull in a bear market, but it turned out to be a bear with everything else, well, guess what? You still knew you weren't going to lose more than 3, 4, 5% in the first couple of weeks or months. Okay? Bearish plays are available. What do I mean by that? Well, for blueprint owners, of course, and for I'm sorry, folks. For blueprint owners and for Fusion subscribers, when you go to radioactivetrading.com and you log on to your account, Fusion subscribers can click on the members-only webinars and white papers here, and there's a full presentation for playing the bear side of the market. It talks about the preferred ways that Kurt, Ernie, and myself might look to open a new radioactive trade with incorporating the limited risk techniques and the income methods on stocks we think they're moving down in price. Okay? For example, I could open a married put on a bearish ETF. I could do another position that's a controlled risk position as a portion of my portfolio that's going to increase as the stock moves down rather than if the stock moves up. Okay? My preferred way is to do radioactive trades on inverse ETFs. And the reason why is because I don't have to think backwards. As the market pulls down, those stocks are going to move up, or even VXX. You know, if the market starts to fall and has the correction you think, the volatility indexes are going to go. So the ETN on VXX will go up in price. So you could use that as a married put. Just do the ETF, the put, ETN I should say in the put. As the stock moves up, you can still apply the same income methods. But that's playing the bear side of the market. So I still have limited risk in play, but I'm having positions that are giving me bullish trends or profits as the market falls. So that is why, the main reasons why, of course, I would look at it in that way. And then, of course, I also mentioned that you can profit on the downside as stocks fall. We showed income method number 12. I could do a different adjustment that would maybe do that also, okay? And, okay, that's, Ash, again, it's okay, I'll say follow-up from Ash is, if possible to make the trade risk-free, is it best to roll the put forward as the trade is risk-free? Depends on the situation. Rolling the put forward, rolling the put up and strike, I only do that income method number 4 if I still expect continued growth. If I think the stock is stabilized and it's going to fall, I might not use income method number 4. And to follow up your question, Ash, can you do a reverse radioactive short the stock and buy the in-the-money call? We don't recommend it, but as a blueprint owner, you can log on to your radioactive trading account. The free registration account as a blueprint owner. You can go into those members-only webinars for blueprint owners, and of course, you'll be able to see the video on playing the bear side of the market. There are different reasons why we don't suggest doing that. You can do that, but I don't suggest shorting the stock and buying it in the money call to create the married call. Some different things come up with that may be a little bit troublesome depending on your broker and what their requirements are and what their fees are, which actually becomes annoying. But it could work out for you. We have different ways to approach it, and that's what's discussed in that webinar for Fusion subscribers and blueprint owners as well. Okay, so long review, Harvey, of that situation. Would I still trade it? Yes, because I've already got positions that are open. I'm going to adjust them with the puts and the income methods. The stocks fluctuate up and down. There is an opportunity to find bullish stocks in a bearish market. I can set up a radioactive trade to profit following the ways we talked about if the market's falling. and I can set it up to profit on the downside as stocks fall, wait till the floor to be hit, which I'm looking at UBNT, and then make an adjustment at that time. And so there's different ways to play it in the bear market as well. Now that being said, I'll be honest with you, this isn't the only strategy I do in my portfolio. I do calendar spreads. I do standard collars as well. I also do credit spreads on the broad-based indexes and ETF. Done a couple strangles and straddles, more strangles than straddles, around earnings events. In addition to playing the married put on UBNT, of course, I did a different position for earnings on UBNT, which turned a profit, actually. All right, and I'm sorry, not UBNT, I apologize. eBay, both positions were profitable. Made more profit on the standard strangle I did on eBay than the income method number 12 I did on eBay with the RadioActive Trade, but they're both profitable. I'm sorry, it was eBay, not UBNT. Okay. So anyway, that's what you can look at there. Can find bearish plays or bullish plays in bear market and vice versa, and you can do different things to profit to the downside as well. All right. Okay, Sam says he bought UVXY in case the market goes lower. His cost is 18. He also owns SPY at 225 to lock the profits. Okay, so Sam's trying to hedge bets there. I don't want to say hedge bets, but trying to ensure one investment on SPY with the other investment in UVXY, which is a good play. I like that idea as far as a market control. And I know Ernie has. I haven't. I think Ernie's bought calls recently on the VIX, the VIX, not playing a market downturn, but planning on a market downturn. So if the market falls, the VIX will hedge part of his overall portfolio. It's something that he does there with the out-of-the-money VIX calls. And VXX doesn't move as much, but it's also UVXY that Sam's in, I think, is one of the 2x ones, so it's going to move a little bit faster. All right. Well, I don't see any more questions coming in. We are at 5:37 p.m. Eastern Time. I just want to remind everyone, if you haven't done so already, if this is one of your first times joining us for a Friday presentation, remember you can test out the PowerOptions tools at any time. Just go to PowerOpt.com and click the over on the right-hand side at PowerOpt.com. You'll see an entry field for first name, last name, and email address. Just put in your information and click Start My Trial Now. You'll have access to a 14-day free trial to PowerOptions. And then, of course, the subscription levels. We do offer an end-of-day service, only $40 per month. Access to all of the search tools and the 20 different strategies and the portfolio tools. We do miss some features, such as the search results by email and the picks of the day that Ernie put together for covered calls and naked puts. The most popular service is the 20-minute delayed service, and that's $60 per month. So you get access to all the tools where the data is about 15 minutes delayed when you run a search. And then, of course, you can upgrade to the historical service, which is 20-minute delayed plus the back testing. We saw some of that today on the historical chamber. You can do historical searches and more. And on the historical service, the data goes back to April of 2006. So almost 11 years of data now on all the options and all the optionable stocks. The real-time service. So every time you refresh the page or refresh the search, you're getting the numbers and calculations at that very moment. That's $120 per month. And then the one that includes everything, the history, the real-time, and access to the programmer's interface, the API, that's $160 per month after your 14-day free trial. Dates are wrong, but the information is correct. So next Wednesday, about February 21st, I believe. No, it's not the 21st. That'd be the 22nd or 23rd. Yeah, next Wednesday, February 23rd, we're doing the Introduction to Calendar Spreads, a broad overview on the definitions and descriptions, difference of a diagonal spread versus a horizontal spread, the nomenclature of a calendar spreads, and a reversal, why they're important, when to use them, and some of the concepts. We'll go deeper into the criteria in the following weeks for calendar spreads, but on Wednesday, 12 noon, basic introduction to calendar spreads, and we'll be back next Friday. Sorry for not changing the dates, folks. But next Friday, 4:30 p.m., we'll have our other open discussion Q&A session for next week as well. All right, let's clear that up. Well, if you think of any questions later on, as I mentioned, I don't see any more questions coming in. But if you think of any other questions later on, just send me an email to support@poweropt.com. I'll be checking it from time to time over the weekend. You can also send us an email to support@radioactivetrading.com. And also you can reach us during market hours at 302-992-7971. And of course, your trial members and subscribers can schedule a coaching session Remember, no coaching sessions are going to be available on Monday. We will be closed, although Ernie and I will be available, and Greg will too. We'll be watching emails and such. We may not be next to the phones if you call in on Monday, but we will be available Tuesday and during market hours. All right, ladies and gentlemen, take care. I hope you all have a fantastic weekend. Those of you who are out on the West Coast, I hope you're not going to be influenced by some of the storms that are still rolling in or coming in. Those of you that might be near me here in the East Coast and the Mid-Atlantic, well, we're seeing a nice warm-up this weekend, so we should have a good weekend as well. Finally, some temperature change, maybe in early spring there before we go back cold, but we'll see. We've had the mildest winter I remember out here in the Mid-Atlantic area, but I know New England got hit a lot, and down south they've seen some storms that we didn't want to see. So anyway, ladies and gentlemen, take care, and we'll talk soon, and everyone have a good weekend. Good night.